Inflation remains the most pressing word in financial markets lexicon right now, and the latest data from America and China on Friday the 10th of June will give everyone plenty to ponder. But the biggest macroeconomic event of the week may come the day before. This is because the European Central Bank, or ECB, will make its latest monetary policy decision on Thursday the 9th. At the time of recording, central banks around the globe have pushed through 133 separate interest rate increases in 2022. That already exceeds last year's total and compares to just 4 cuts. Now, the direction of travel seems clear, for the moment at least, as central banks move from fighting pandemics and the threat of deflation to tackling inflation and its pernicious effect upon living standards. For all of that, the ECB so far has done very little. Its balance sheet has continued to swell under the auspices of quantitative easing, or QE. Total ECB assets now stand at a record high of 8.8 trillion euros on its balance sheet. That's 15% higher than a year ago, 88% higher than before the pandemic, and 196% higher than 10 years ago. The central bank has also left its headline refinancing rate unchanged at 0, a figure that's actually applied since March 2016. The ECB's last rate rise was pushed through, I think, in July 2008 by then President Jean-Claude Trichet, a decision for which he was roundly pilloried. As it turned out, he tightened policy going into a steep economic downturn and, in fact, a financial crisis for good measure. That bruising experience, plus the fragile state of the European banking system, financial market volatility in countries where rates are going up and quantitative tightening is underway, may all be giving the ECB pause for thought this time around. In late 2021, President Mademoiselle Lagarde even suggested there was no chance of rates going up until 2023 at the earliest. However, a surge in inflation across the EU's 8.1% year-on-year in April could be forcing President Lagarde and the ECB's hand. The central bank has begun to drop hints it may raise rates by a quarter point in July. Some economists are expecting 2 more quarter-point rate hikes after that by the end of the year, although do note that Dutch central bank governor Klaas Knot is reportedly pushing for a half-point rise in July. Any guidance from the ECB after this, the June meeting, could therefore be particularly informative. Back home, the list of scheduled corporate announcements is relatively short, although it's still possible that unscheduled ones will keep everybody busy. Names on the current list which may be of interest include the following, although do note as ever that some of these dates could be subject to change. Gooch and Housego and Marks Electrical on Tuesday the 7th of June. Aveva, Wizz Air, Workspace and Ramsden's on the 8th. Tate & Lyle, Mighty and Norcross on the 9th. And Ben's Creek, Naked Wines and Hornby on Friday the 10th of June. But the company which might just cause the biggest fuss in the week ahead is British American Tobacco. The company behind the Kent, Dunhill, Pall Mall and Lucky Strike brands, as well as Views and Glow, is scheduled to release a first quarter trading update on Thursday the 9th. The shares are up by a quarter over the past year, and they trade close to a 3.5-year high. This may be down to the perception that tobacco firms are a potential hedge against inflation, as demand for their product is fairly price inelastic. Consumers seem to keep buying even as prices rise, and tobacco firms are using those price increases to offset the ongoing and gradual decline in stick volumes. They're also trying to use their brands to take share from smaller rivals. These first quarter results were the latest step in the transformation plan outlined by boss Jack Bowles when he took the helm in 2019, although BAT has had to refine its full-year guidance for this year owing to its withdrawal from the Russian market back in March. Russia and Ukraine between them had represented around 3% of global group sales and a little bit less of group profits on an adjusted basis. And it's by that refined guidance that these quarterly numbers will largely be measured. BAT is now getting to a 2% to 4% growth in revenues on a constant currency basis for 2022. That's based on the assumption of a 2.5% drop in global stick volumes, offset by price increases and market share gains. At the moment, analysts are looking for a 3% sales growth on a stated basis to £26.5 billion. The company is also now guiding to mid-single-digit percentage increases in earnings per share on a constant currency basis, compared to last year's 329.6 pence, helped by cost savings from its quantum efficiency project. On a stated basis, analysts have penciled in a 9% increase to 323 pence a share from 296 pence a year ago. And BAT is targeting 90% operating cash flow conversion. That's all important because it funds the dividend and the ongoing share buyback. Analysts are looking for dividends in 2022, slightly up from 2021, and the firm's running a $2 billion buyback now, although it is unlikely that Mr. Bowles will discuss those numbers at this point. The final item of interest will be progress at BAT's new category on next-generation products, such as Views and Glow. In 2021, the FTSE 100 firm added 4.8 million customers here to take the total to 18.3 million, as it grew revenues by 50% to just over £2 billion and reduced its losses. The long-term target for next generation or new category products is sales of £5 billion and a profit by 2025. Thank you for watching. I hope that you and your families are all in good health and good spirits. Enjoy the Jubilee weekend, and I look forward to seeing you next time.